I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back, Jim.
Your summer in Ontario so far?
Certainly a wild weather pattern we've had here. It's the firestorms in northern Ontario are certainly leaving cause wishing that the Mars bomber was operational and flying here in Ontario. That's for sure.
Yeah, and here in Vancouver and Richmond, they have a bog fire that they don't know when they're going to get out. And it's totally smoggy out there. But for some reason, the government doesn't think they should use one of the best firefighting aircraft in the world. We're digging into it. There's got to be some kind of political payoff taking place, some reason not to use something that was built in the 40s, but the cockpit itself is totally modern. And it gives it capabilities that it puts out 4 acres of fire at one time. And you look at your local fires, if you could put it out right away, you wouldn't threaten all these homes and lives.
Exactly.
And so I guess because we're talking real estate, it's important to talk about fire protection. By the way, at the BC Union of Municipalities meeting a few years ago, mayors asked for the right to call in the Mars water bomber if they felt their community was threatened, and the provincial government refused to give them that right. Why?
Just crazy. Just crazy.
You know,
Sorry.
If the neighbors have got a better fire truck, why not use it?
Exactly.
Anyway, Ross, first question here. Young families right now are so worried about ever getting into home ownership. We hear that they're looking at zero-down home purchase techniques that have recently been offered by some non-bank mortgage lenders. What's your opinion on these mortgages, and how should families be looking at this?
Well, young families, first-time buyers, really should be very careful because these are setups. These are setups by the lenders and even the mortgage brokers to try to make some commission, try to get you into a property. What I mean to say by that is that interest-only mortgages are a fantastic product if you're using that product in the way it should be used. Now, what I mean by that is that instead of paying principal down, you use the exact same amount of money you would have spent on principal and you invest it in something else. So you have a financial advisor somewhere who you can trust and can give you advice, and you invest that money. That said, for first-time buyers, the people that these products are targeting, they also target investors. For those people, it's really the last thing you want to do, because as a first-time buyer, the way that you're going to build net wealth in your house in a correcting housing market is if you're able to pay down your principal. And you also want to be in a position in a correcting housing market that if the value of your home falls, which it is going to do, that when your mortgage comes up for renewal, the bank doesn't ask you for some extra funds. In other words, any shortfall, the bank doesn't ask you for. Because that would pose a risk to the first-time home buyer. Now, what I'll tell you, Jim, is that we have never watched that happen in Canada. We have never had a period where the banks, certainly since the early 1980s, when we had those 20% interest rate mortgages for a short period of time, when your mortgage comes up for renewal, even if your equity position has changed, in other words, your property has dropped in value, the bank still will honor your mortgage and they will renew it for you. You may not be able to port it to another bank to get a better rate. You may be forced with staying with the bank that you're at, but at least you can stay there, and generally speaking, you can get whatever their normal discounted rate is. These products for investors the same way. An investor shouldn't use one because the investor really, in this kind of an interest rate environment where we're looking at sub 4% mortgages, you're looking at principal pay down, again, is a great way for you to build your wealth from your investment. So you really want to be paying down the mortgage, if at all possible, having your tenants pay down your mortgage while they're renting the property. The second that an investor goes to a 0% down mortgage with their or interest-only mortgage, what they're saying is the property value increase is what they're going to rely upon. And that really is no longer investing. That's speculating. You're a speculator. There is no need with residential real estate to have to be a speculator. It's better just to have a great investment plan. So, first-time home buyers that are listening to the show, stay away from these mortgage products. There's no need for you to go to them. You have been able to buy with 0% down in Canada for going on 35 years. There has been methodologies available with CMHC insurance that will allow you to purchase with zero down payment. What I'm telling your listeners are right now is that now that we're into the rising portion of the interest rate cycle, do not enter the housing market with a 0% down mortgage or with interest-only payments. You're just setting yourself up to be the highest risk homeowner in Canada.
We'll have more with Ross Kay right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Ross Kay. Ross, a young couple in Calgary are looking at selling their current home to get a larger house as their second child is on the way. They're wondering, is this a good time to trade up in Calgary, or should they wait longer for a better bargain?
Good question. A very common question, Jim. Probably, I will bet I've had that question hundreds of times over the last 30 years when I was actively selling houses. When you're working your way up the property ladder, as it sounds like this young couple is, you have to look at the situation of the home that you currently own, and then you also have to look at what your ownership situation is going to be on the property that you want to trade up for. In other words, generally we're speaking about this young couple is going to take on a larger mortgage. They're going to move to a house that costs them more money to buy, a house that costs them more money in upkeep, more money to heat, more money in hydro, even though I heard the light bulb story 100 times, same number of light bulbs in a house are turned on. That's not what happened. Your hydro rate also, the amount you pay for hydro also increases. Your maintenance and upkeep in the property increases. Depending on the age of the property, there could be a substantial difference in the amount of renovation work that needs to be done between one home and another. So all these sort of things have to be taken into consideration. All of that said, in a place like Calgary, where inflation alone is driving property values down since 2014, and where new homes, the price that people are paying for a brand new build that has never been lived in before, have also been falling. Creates a great opportunity for trade-up buyers. Now, not only is that a good opportunity for the trade-up buyer, it's also a great opportunity for your society, because even though money that is spent when money is spent in the resale housing sector, a lot of that money's value to the economy is not realized. It's simply money that is shifted into from one account to another, and it's inevitably shifts into mortgage debt, which means mortgage interest gets paid. So other than the banks, there was really no one benefiting from that. A new home construction, purchasing a brand new build, is just the opposite. You are creating jobs. You are immediately creating an improvement of the overall housing stock in the community that you're buying in. You are buying into an area where there will have been massive development has had to go on. So you got streets, roads. Your city has expanded. There is just lots of positive economic consequence when a Canadian family purchases a brand new home. One of our biggest frustrations, Jim, is that the Canadian Home Builders Association is in cahoots with the Canadian Real Estate Association, because the Canadian Home Builders Association thinks that the housing market has to be busy for them to succeed, for their members to succeed. We know just the opposite, because we know that during the 1990s in Ontario, builders actually did their best of all times, because home buyers in a correcting housing market always prefer a higher or newer quality home. The reason they do that is because if it's a brand new home, in all fairness, in the first 15 years that you own it, other than cosmetic changes, you really don't have to change anything to the house. Sure, you'll go ahead and put some fences up, you'll put a deck up, put curtains in, but you're not going to have to put a new roof on. You're not going to have to change the siding. You're not going to have to update the insulation. So the first-time home buyer or a trade-up home buyer in a correcting housing market really always has a really, really high desire to look at brand new builds. And that's a great time not only for the builders, but also for the economy at large. Because we know in a correcting housing market, the economy takes a hit. From our own data, Jim, over the last 40 years that we cover in terms of this segment of our data, every time that the housing market has been correcting, which means a correcting, measuring it the way that we measure it, the economy moved into a recession. So this will be the first time whether or not we'll know, is this going to be the one time where it doesn't happen? It happened in 1990, and we will say that it didn't really happen in 2008 because the market only reached its contraction phase, the way that we measure the market. It didn't reach the correction phase. The last time the Canadian market was in a correction was in 1991. This is the second time where the market has reached this phase, where it's reached a measurable determination of a correcting housing market. Now, it's a long discussion to get into how we define that correction, so I'm not going to do that right now, Jim. But this is what this young couple in Calgary needs to understand. If they go out and they purchase a new home, new homes have fallen in price in Calgary since 2014. New builders are getting less and less and less for their homes. What that means is the value of the land that you're buying is dropping in price. You've got to understand, the building itself is not going to drop in value. The building itself, inflation, is going to be affecting the 2x4s, the screws, the labor, the windows, the roof, everything that's attached to that house. Inflation is not going to let that drop in value. Yes, the builder may take a smaller profit on the building of the house. In other words, instead of taking maybe 30%, he's going to take 20%. And he's still happy because in a normal housing market, you get a 15% return. You're doing great as a new builder. But the land itself is what drops in value. And when that land drops in value, that's when it's an opportunity to buy. So the young couple in Calgary should be looking at a brand new build They should be looking at the situation they have owning their current home and the situation they would have should they buy the new one. And it's possible right now in Calgary that you can make one step in the property ladder, and it is a very, very minor difference in the actual cost of ownership. Now, this is not a carte blanche. This is not everybody is the same. This is general information, so please don't go out there and do that just because you've heard me say that it's a good idea here on the show. Your individual situation needs to be detailed and laid out for you. But that said, the opportunity in Calgary is a very good one right now if you want to move up the property ladder.
We'll have more with Ross Kay right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, last week the Canadian mortgage professionals released a report that said home sales were lower this year because of the new mortgage stress test. You've said repeatedly that the slowdown was not caused by the stress test. What is going on, and what do you think of this report?
Yeah, so this is Mortgage Professionals Canada. They used to be CAMP. Now I think they're CMP or something like that. The author is the same guy. It's Will Dunning. Will Dunning years ago worked at CMHC. I think it was in the 80s. Might have been in the 90s, like Greg Klump over at CMHC. So these kind of reports, Jim, they really just cause problems for the public because it's a false narrative that is always never supported with the data. So you are going to see this report was done based on a survey. You're not going to see any corroborating data supplied to support it. In other words, it's just a theory. And it's another failed theory because if that was true, then people in the spring of 2016 in Ontario would not have received advice from us that the real estate market was already contracting in the spring of 2016. So what this report said is they were trying to blame the slowdown of the housing market on the mortgage stress test, which they were saying removed 100,000 or more first-time buyers from the market, which we would say is hogwash. The reason we say that is that first-time home buyers could not support the housing market in British Columbia or Ontario as of the spring of 2016. What we saw in British Columbia was an absolute collapse of your market that was happening prior to your foreign buyer tax come in. Then you saw the government put a $37,000 boost on first-time buyers, which carried your condominium market right up through till the spring of 2018. Detached housing prices were dropping, condo prices were increasing. That was simply a result of the $37,000 boost. In Ontario, there was no such boost, but we saw the huge house price gain take place between the spring of 2016 and the spring of 2017. Your listeners can figure this one out for themselves. If the average selling price all of a sudden quits counting as many first-time buyers, that means you get higher house price gains because first-time buyers are not holding the average selling price down any longer. The only way that you can get that 30% claim of year-over-year gain on real estate prices is because there are so few first-time buyers buying that the share of sales to people who are trading up to more expensive homes jumps. And that's how you get that change. Will doesn't measure that. Canadian Mortgage Professionals doesn't measure that. So they don't know that the Ontario housing market in the spring of 2016 had entered its contraction. They don't understand that. What happened in Ontario to get 30% house price gains was, once your housing prices increase to a certain level, there have to be added steps in the property ladder. There are not enough first-time buyers in the market to keep supporting 500,000 sales a year when the sales chain, which is what we measure, is only 3 lengths long. In other words, a first-time buyer buys a house. The person that owned the house that they bought purchases another house, and it happens one more time. Okay, that's a sales chain that has 3 links in it. You can't get anything above about a 4% annual house price chain, a house price gain, when your sales chain is only 3 links long. You need a sales chain that is over 5 links long to be able to get a excess of a 20% house price gain in any one given year. That has only ever happened 2 times in the history of Canadian real estate where it got that long. There are reasons why the chain gets that long, but just bear with me when I'm telling you that's only ever happened 2 times. So what they're saying with this report was, Jim, is that they're blaming the drop in sales in 2018 on first-time buyers, when really the drop in first-time buyers happened way back in the spring of 2016. Because that is what caused all the house price gain over the next year. Now, in British Columbia, where they had that $37,000 boost, what it did was the big single detached homes didn't sell. Well, how is that possible? The condominium sales increase, but the detached home sales decrease. Well, the reason for that, why, is because your $37,000 boost got multiplied with each link in the chain as each family traded up to a more expensive condo. What Mortgage Professionals was trying to say is they're trying to say all of a sudden the B20 is impacting first-time buyers, and there's 100,000 of them that didn't buy. It's simply hogwash. The first-time buyers weren't buying in 2016 and 2017, and that's how you got your house price growth, because fewer, cheaper houses were selling. More expensive houses were selling. So that's my synopsis of that report. I would also tell your listeners that he wrote a report back when Flaherty changed the mortgage term from 30 years to 25 years. I think if your people go back and find that report and they read it, it's going to have almost the identical wording, where Mortgage Professionals came out and claimed fewer first-time buyers were entering the market because of the change in the mortgage rate. We know what happened was sales increased again. It had nothing to do with the drop of from 30 to 25 years in the amortization, which naturally makes your mortgage payment higher. But they made the exact same claims back then. So this is simply a case of someone believing something that isn't true. And unfortunately, when an organization needs commissions, in this case, Mortgage Professionals need to book mortgages to make a living. If the housing market slows down, their members are going to make less money, same as the Canadian Real Estate Association. They produce reports that create a false narrative. Whether they do that knowingly or not, I don't know, Jim. It is highly likely they simply are that ignorant to how a housing market works. That said, the report is there. People can read it, and they can listen to the explanation that I just provided, and then they can go to the local real estate board stats and see if that's exactly what happened with the house price gain that I said would take place.
Ross, with July almost over, what do you expect to hear from housing markets around Canada from July's real estate board press releases?
Well, what we're going to hear is we're going to hear that things didn't jump the same way that they jumped in June. The same way that the public was conned with the seasonally adjusted June number, because the June of 2018 was what we call a bump month. In a bump month, more sales get reported in that month because of the way the calendar rolls out. So what that means is last June was a non-bump month in the year 2017. That meant that fewer sales were reported in the month of June than actually took place in the month of June. This year, in 2018, because June was a bump month, more sales than took place in June got actually reported in June. There were sales from July, the first 2 days of July, and from May that got reported in June. That, when you put that into a seasonally adjusted methodology, it creates an illusion. It creates a falsehood. And that's what you saw reported in every single newspaper across Canada. You saw the housing market has stabilized. The housing market has gotten busier again. The housing market has done this. It's rebounded from May. We have been waiting all spring for the housing market to rebound, and it's finally rebounded. You can go find this exact same report and wording in every bank in Canada's website. Their economists have said the exact same thing, because they don't understand how you measure real estate stats. You can't just use a single month of stat, and they're going to find that out now. If we look at Calgary, I think Calgary was down about 12% last month. Okay, they're not going to be down 12%, because the way that their real estate board reports sales, they didn't report those June sales in June. They're going to actually report them in July. So they're not going to look as bad as they did in June. So it goes from real estate board to real estate board. Now, what is different is that it is a provincial phenomenon. So in other words, in Ontario, because the Toronto Real Estate Board has commanded so much market share, how the Toronto Real Estate Board releases their stats, how their members react, really messes up seasonally adjusted numbers. It always creates a positive number for the real estate board to earn commissions between 4 and 8 months of the year. There are 4 to 8 months of a year. It changes year to year, so I can't tell you what it is every year. But there are 4 to 8 months in any given year that are bump months. When those bump months happen, depending on how the housing market, where the housing market rolled over, and what path the housing market is on, they have a tremendous impact on seasonally adjusted. It's why we tell your listeners over and over again, you can't use seasonally adjusted numbers. So what we're going to see in July is you're going to see reported some boards, things didn't turn out as good as they did in June, but don't worry about it. Maybe things will pick up in August. Other real estate boards are going to say, things are staying the same in July as they were in June. And other real estate boards are going to say, it's worse in July than it was in June, or better in July than it was in June. So these are the sort of confusing things that home buyers face every single month when they listen to real estate stats. The reason you need to know where a housing market is headed and where house prices are going is because you need to know whether or not when you go to close in your home, in other words, you buy it today, you're going to close on it 3 or 4 or 6 months from now, whether or not it's going to be worth more money or less. Young first-time buyers in the province of Ontario right now who entered into pre-sale contracts on brand-new homes, there's an article in the Toronto Star today, Jim. There is a couple in there whose brand-new house is being built. The builder put the closing date off 2 times. It is now worth $100,000 less than what they paid for it. That's because when they purchased the house, they didn't know where the market was heading in the future. The same reason that we knew in the spring of 2016 that housing prices were going to crest a year later and that it would take even longer for all of that momentum to work its way through the market in Ontario, people get fooled thinking the housing market turns overnight. You get cited cases here today, Jim. Mortgage Professionals Canada, not the foreign buyer tax, the change of the mortgage stress test, that couple in Calgary that you talked about. These are all cases where the people don't understand where the market is headed prior to making a decision. Or they try to explain a housing market using flawed metrics, sales stats, real estate board created stats. It does not take a crystal ball to read a housing market, Jim. It is a black and white path. We refer to it as a set of railroad tracks. That train is on the railroad track and it can't change. The train can only go up the mountain so far before it doesn't have enough power to go up any further. And then it starts heading back down again. You need to be measuring the train all the time so you know whether it's retreating or whether it's going to keep going up the mountain. That's how easy it is. It isn't a crystal ball. It isn't it's magic how we can forecast this stuff. It's simply that we understand how the housing market works, and we have our own metrics that record market momentum. We have our own metrics that measure the number of links in the sales chain. We have our own metrics that measure first-time buyers' share of the market. We have our own metrics that measure the impact of mortgage rate change on the sales mix that is buying real estate today. And that's just a start. So all of this thing is possible. It's all math. It's black and white. And the reason why it's black and white is everybody has to borrow mortgage funds to buy a house. Those mortgage funds have to be borrowed. Today, the Bank of Canada's new mortgage data got released for June. And once again, you had a huge drop in mortgage growth. We don't look at mortgage growth. We look at the amount of mortgages booked in the month. It is a totally different metric. But that's how we know your financial advisor has to be telling you right now what the bank's share value is going to be if they don't book as many new mortgages next month. And if you own bank shares, because this is a 100% certain calculation, someone should be able to give you that number. I can't. We don't know how to calculate what a bank is worth based on its mortgage book. But I'm sure that there's experts out there that can. What we can do, what nobody else apparently is able to do, we can tell you how big the mortgage book is going to be next month. We can tell you how many brand new mortgages are going to be booked next month, the amount, the volume, the amount of mortgages. From that, your financial advisor should be able to tell you whether or not each bank or any bank is worthwhile you have investing in, because it's going to affect that bank's profit. So, long story short, Jim, there you go. These things are black and white, no confusion. It's not brain science. It's simply real estate math.
Ross, thank you so much for being on the show.
Hey, thanks for having me back, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests like Ross can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.